In my previous video, you learned who won between a single premium immediate annuity and an office building. Well, of course, it was the SPIA. I think I labeled it as the one-punch knockout. It may have something to do with the low-cost contract, no maintenance required about you in order to maintain the level of income benefits from month to month, and the fact that you continue to get those income benefits guaranteed each and every month, no matter what is going on in the world. So is there any need for a round two? Well, probably not, but I figured this would be an excellent opportunity to refresh you on what the tax treatment is for a fixed annuity. So let's see if we can level the playing field between a SPIA and an investment property by including taxes. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. Let's start by talking about the tax treatment on a fixed annuity. So one of the annuity benefits is tax deferred growth. So you're not going to get a lot of tax deferred growth from a single premium immediate annuity since the deferral period is less than 12 months. But for a deferred annuity, that deferral period can be up to 45 years. So annually, you do not have to pay taxes on the growth from your deferred annuity. So that is not true for a CD. You do have to pay taxes every year. So by not having to pay taxes on that growth, you're keeping more money in your deferred annuity to earn compound interest. So as a reminder, compound interest is where you earn interest on interest. So the more money you leave in that deferred annuity, the more chances you have to multiply the growth of your deferred annuity due to compounding. Is there tax deferred growth on an investment property? Well, not quite. So the government does allow some temporary deductions that you can offset from your net rental income each year. And that example would be depreciation. So depreciation, you would take it each year as an expense, reducing your net rental income over the life of the property, which could be anywhere between 27 and a half years and up to 39 years. So what that means is that at the end of the useful life, let's say it's 27 and a half years, you fully depreciated your property so that the cost of the investment property is zero and you can no longer take any more depreciation expense deductions. Keep in mind that the depreciation is a temporary deduction that is recaptured when you go to sell the property. So just again to reiterate, you do get a few benefits to reduce your net rental income, but you are going to have to pay taxes any year that you have net rental income. As I discussed in a previous video, you can put a fixed annuity in a traditional IRA, a Roth IRA, or a taxable account. So just to give you a refresher on the tax treatment for the contributions for each, in a traditional IRA, it's typically pre-tax, which means you don't pay taxes on the money that you invest in the traditional IRA. For a Roth IRA, you pay taxes on the amount that's invested in the Roth IRA. And the same is true for a taxable account. Well, surprisingly so, there are ways that you can put in an investment property in a traditional IRA, a Roth IRA, and a taxable account, which is the way it's been done for many years now. Leave me a comment in the section below and let me know if we've leveled the playing field between a fixed annuity and an investment property, or if the fixed annuity is still the clear winner. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit the notification bell so that you can receive notices anytime I post a new video. So far, I've talked about the tax treatment on contributions to a fixed annuity depending on the type of account. I've talked about the tax deferred growth during the deferral period, no matter what type of an account you put that fixed annuity in. Now we're going to talk about the tax treatment for those income benefits that you receive from a fixed annuity, depending on the type of an account. So if the fixed annuity is in a traditional IRA, so you remember it was pre-tax contributions, so you're gonna have to pay 100% taxes on those income benefits that you receive. Now, if the fixed annuity is in a Roth IRA and you follow all of the guidelines established by the IRS in setting up that Roth IRA, you never pay taxes again. You pay taxes on the contribution and then you never pay taxes again. Now, if the fixed annuity is put into a taxable account, you will have to pay taxes on the growth in your fixed annuity. And those taxes are computed based on a method referred to as LIFO, which stands for last in, first out. Now, what about an investment property? Do you pay taxes on those income paychecks that you receive from that property? Well, not quite. You're actually going to pay taxes on net rental income. It's not based off the cash you receive from that property. And there could be years where you're paying taxes on net rental income, but you have no money from the property. And that could be because you're reinvesting the money in the property, whether it be to maintain the property or to improve the value of the property. One other thing to note about an investment property is that if the property is located in a state outside of the state of your residence, you will have to pay taxes on that property for the state where it is located. So you can see how it would get quite cumbersome if you own several investment properties in different states. So let's review real quick. For a fixed annuity, we've talked about guaranteed income, money that you cannot outlive if lifetime income. The fact that there is a low cost associated with that fixed annuity. And there's very little work required from you in order to maintain those income benefits that you receive. And you receive those benefits no matter what's going on in the world without even a pause. And now I'm telling you that you may pay less in taxes than you would with an investment property. And then less stress. I mean, we already talked about the fact that an investment property can create a lot of stress in your life. So I think fixed annuities are back on top as compared to an investment property. What do you think? Just to clarify, I'm an advocate of you owning investment properties in your retirement portfolio for both the income benefits and the fact that you possibly own an appreciating asset in your retirement portfolio. So it's always good to fully diversify your portfolio between different asset classes to help reduce risk, but it's also good to leave room in your retirement portfolio for a tool that is not reliant on market performance, but rather it's reliant on a solid, financially sound insurance company. So leave some space in your retirement portfolio for a fixed annuity, whether it be a single premium immediate annuity or a deferred annuity, so that you can ensure that you still receive those income benefits without pause, no matter what's going on in the world or what's going on in the markets. And if you have enough money in your fixed annuity to provide you income benefits to cover your basic living expenses, then when market downturns occur, the only stress you have is whether you want to stay in for the evening, whether you want to travel, or even which restaurant you want to go to. So only a fixed annuity can provide you that financial security and certainty in your retirement. So if you're wanting to obtain the contractual guarantees that a fixed annuity can provide your retirement portfolio and give yourself peace of mind, financial security, and certainty in your retirement, click the link below to apply to become my client. Also, if you enjoyed this video, be sure to give me a thumbs up, subscribe to my channel, and share it with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.